Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. This video is part 10 of our asset allocation series, and this is going to be the last video in that series. So in this video, I'm going to talk to you about certain types of assets that I haven't mentioned before in prior videos that are examples of things I would never invest in. So I'll explain to you a little bit about what those assets are and just tell you why I would never consider those good investments to make. So if you haven't watched the prior videos in this series, I've linked below to part 1 and 2. I highly recommend you start there before going all the way through to understand my thoughts on how you should think about allocating your money across the different asset classes. So just a quick reminder, this is the asset allocation series where I'm talking about how you should allocate your money across the major asset classes. We are here in the other category where this is just an example of miscellaneous types of assets that don't fall neatly into these other buckets that are things that I would not invest in. So anything in this other category are things that I'm not investing in at this point in time in my life. There are investments I'm not going to discuss in this video like bonds, hedge funds, things like that are examples of things I would never invest in or own myself. But here I'm only talking about things I haven't covered in prior series. So if you haven't watched all the other, previous videos, part, 1 through 9 before this one, I highly recommend you go back and start from the beginning. So before I talk to you about the specific types of assets that I would consider, never investing in myself, I just want to run quickly through and summarize the key investment metrics I look at before I make an investment. And so this is going to really help frame for you why I don't invest in the assets on the next slide. So I'm going to run through these very quickly because if you're familiar with my other videos, none of this is new stuff. I don't invest in anything that doesn't make at least 10% returns on average. The S&P 500 in modern history on average returns at least 10% every year. So there may be years where it's higher than that, and there's definitely years where it's lower, but on average it's 10%. So I'm not making an investment that doesn't beat that, right? If I can't beat the market, I'll just leave my money in the S&P 500. So if it doesn't make at least 10% returns or isn't expected to, it's not even going to come across my desk as something I would consider. Tax efficiency is really big for me. I don't make investments where I'm going to pay a lot of tax. I always think about my returns on an after-tax basis. So I think about what tax am I going to pay on the distributions or money I make from the investment, and, as well as the returns if I have to sell that investment in the future. And also, in addition to that, what tax planning strategies are available to me to reduce the taxes overall. So it's just, what is the kind of blanket tax rate you're going to have to pay on the investment and the returns from that investment? And what are the strategies available to you that you can reduce that tax? I don't invest in assets that have a short-term strategy. So things like hedge funds that really play on short-term trading are not for me. It's not my cup of tea. I'm a long-term investor. I like to buy and hold for the long term. The best assets, in my opinion, are the ones that you can own forever. I like transparency. If I don't know what I'm investing in, I'm not going to do it. So if it's not clear to me what the strategy is and what I'm investing in, it's just not even something I'm going to consider, even if it is a fantastic investment at the end of the day. Also, I have to, same as this before, I have to have a good understanding of what the asset is and the investment strategy itself. So, as Warren Buffett says, don't invest in something you don't know. Before I make that investment, I've got to really understand what that asset is, all the considerations relevant to it, and what the strategy is around making that investment. Deal access is very important. So I need to consider, are good opportunities available to me? And everybody needs to consider that, because depending on where you are in your net worth building journey, your wealth building journey, you're going to have different access to different quality of deals. So for example, if you're not a accredited investor yet, and you don't have over $1 million of net worth, the ability to access good real estate investment funds or, options to invest in real estate that don't involve you going out and buying the property yourself, it's not good quality in my opinion. So I'm not making those investments. Whereas once you are an accredited investor, you do start to get access to what I think are much better quality real estate investment funds and syndications and things that you can invest in real estate more passively without having to go out there and buy the properties yourself. So that's a good example of why deal access is so important. Also important is stability of asset class. So I like assets that are, have net increases over time. I don't care about short-term volatility. So yes, the stock market is very volatile. I lose tons of money and gain tons of money every day. I could log in at any minute and be down six figures at times, and then I could be up, double that tomorrow. I don't care about that. None of that is relevant, the bad or the good there. What is relevant to me is what is that investment going to be in the long term? So, this is going to be important, and I'll point this out in the next slide when we're walking through specific assets, but I like to see steady appreciation over time. It's never going to be straight up, and it shouldn't be straight down, hopefully, but I don't like to see things that are pretty flat when you look at them on a 10, 20, 30, 50 year basis. To me, that's a bad investment. Also, lastly, is I think about my time versus the return potential. So if it's a business that I'm going to have to own and manage, and, if I'm going to have to worry about spending time on it every day, so like my business, that I own, that's always going to require some element of my time. So the returns that I need from that need to be significantly higher than if I'm just writing a check for a real estate fund where I'm not really doing anything past the due diligence stage. So that's very important. If it's going to require a lot of time, the returns need to, justify that. If it's not going to require a lot of time, then, the S&P 500, I can just go out and buy a S&P 500 index fund, make my 10%, on average, and I'm happy with that. I don't spend any time on that, at any point during the year. So you have to think about it that way. Time is money, and the returns need to, justify the amount of time that you're going to have to spend on that investment. Okay, so let's just walk quickly through 7 types of assets that I would never own. So these are things you've probably heard of before, and I'm just going to explain to you really quickly what they are and why I would never invest in them. So I'll start with annuities. I have this snooze sleepy face emoji because I think that, they are really a snooze fest. I think this isn't really something that most people don't understand at this point, but annuities are really outdated. That is where you're paying, a fee basically to have a future stream of income. So you pay premiums now in exchange for some stream of income in the future. And, I wouldn't consider this an asset. I would not consider an annuity an investment or an asset. I actually think these are kind of crazy, and the only people who really recommend them are people who sell annuities at this point. This is the kind of stuff like our grandparents had that just we aren't doing anymore. So, the only people I do think should have annuities is people who can't trust themselves to have enough money when they're, at retirement age and need to do that. So it's really more for kind of, I think, financial responsibility issues. But for those of us that are trying to build wealth and trying to, get financial freedom, an annuity just doesn't make sense. And again, I would not consider that an asset. So foreign currency is interesting. So the economist in me really kind of likes, watching foreign currency and trades based on, fluctuations in foreign currency prices. So this is, if you're not familiar, this is like do things like trade euros and stuff as compared to the value goes up and down to the US dollar and try to, make some gains there. So I'm not a fan of foreign currency trades for a number of reasons. A large portion of it is the tax inefficiencies. It's really short-term investing mindset there. You're speculating. You're going to see that with a lot of these. Basically, most of these, you're just speculating, right? You're just kind of guessing. You're looking to trade on the short term. So there's a number of reasons why I don't like foreign currency. Also, the time that you would need to spend, you have to, to do this well, you have to really understand economics. You have to really understand, geopolitical events, things like central bank policies for the countries where you're, trying to trade those currencies. So I think the time requirements to do this and do this well and be successful on a long-term basis really are going to outweigh the returns that you're going to get, especially on an after-tax basis. So 3 and 4 kind of go hand in hand, but I separate them out for a reason. So collectibles, I think we know what this is. These are things that, you think the value is going to increase because of the scarcity of the item. I always get kind of Beanie Baby vibes with this. Back when I was in middle school, Beanie Babies were the big thing. And I remember I went over to one of my friend's house and she had these huge bins of Beanie Babies. I mean, I just was never into them. But, this friend would always say crazy things. And so one day she told me, I have millions of dollars worth of Beanie Babies. And I thought my little middle school self, I wasn't being fooled by that. And I thought the whole trend was kind of silly back then, but I've never been into collectibles. I mean, you're speculating again, it's not something that I think is really truly a good investment to make. Same with artwork. So the reason I separate this out, I mean, it's the same thing. It's like you buy a piece of artwork, you hope, it appreciates in value. Sometimes people do this, for when the artist dies, hopefully it'll increase in value. So I separate this out because a lot of funds are popping up, it's art trading funds, and I see this out there. I get kind of shady vibes from these when I see these. It's not something I would ever invest in. Still speculating, it's really not what I think is a good long-term investment based on things that really make a lot of sense. You're just kind of doing it based on a scarcity mindset. So The one time I do think collectibles and art and that type of thing makes sense is if you want the item. So it's not really to make an investment item, but say there's a nice painting I want and I want to hang that in my home, then yeah, it's not a bad idea to make that investment, considering that you might get more back from it. So you're really not necessarily out the cost fully, because it's not like a painting where, nobody's going to want it because it's worthless when you die or when you want to get rid of it and replace it. It's something that hopefully you could sell, in the future. So, I'm not really into expensive things for the most part. I would like a signed LeBron James jersey. So that might be something I would consider here, but I would know that I'm getting that in order to just have that item in my house and because I want it, and not because I think it's really an investment. So I think it's just important with the mindset there when you're thinking about buying these types of things. So 5 and 6, commodities and precious metals are often considered, precious metals are often coupled with commodities, but I'm going to separate them out for a reason. So commodities, I'm talking about really raw materials for manufacturing or consumption. Think things like oil. A lot of people like to trade oil. I think most people I know that are pretty active investors do invest in oil and gas. I have always stayed away from that area. If anyone I know who's had a situation where they just lost all their money or really got in bad shape, it was always an oil and gas project. So I'm not a fan of those. I try to stay away from them. Commodities can also be things like corn, wheat. I know people who trade crazy things. Like you would never believe that they're actually doing it. They're trading things like cows, for example. So I don't do this. I don't invest in this. You're still, again, this is speculating. This is not something you're going to own for the long term. There's all types of reasons I wouldn't want to invest in commodities for, beyond this video, but it just doesn't line up with my investment philosophy, and the returns just on a long-term basis don't make sense to me. Precious metals. So these are the metals that are really rare. So think gold, silver, copper. Gold and silver are the most popular. You've probably heard of it. So gold is an interesting one. There are a lot of people who think gold is, a little bit different. There are a lot of people who think these things are good, hedges against inflation. But again, you're just speculating. If you look at the price of gold, it is not a good long-term asset. You're not seeing that kind of long-term steady appreciation over time. So, you have to think about the opportunity cost of these things. So, if you're investing in things like silver and copper, what could you have been making with that money? That's what you've always got to be thinking when it comes to investment returns. You're not getting great, on the tax side. Most people who do precious metals are doing them in a Roth IRA so that they can avoid the tax issues there. But you're just speculating. These are not good long-term investments, so I don't like them. A lot of the people who own gold are going to be those kind of doomsdayers too. They think if the world ends, boy, am I glad I have my gold. I just think if we're invaded or the apocalypse happens and the zombies come, I'm not going to be sitting there thinking, oh, thank God I've got this big pile of gold that I can't take anywhere with me because it's too heavy. So that's never made sense to me. I stay away from gold. I know a lot of people would disagree with me. So if I haven't, kind of made you mad yet, I know there's going to be a lot of people get ticked off with number 7. There's going to be a lot of people who disagree with this. I do not believe in investing and owning derivatives. So derivatives, when I talk about derivatives, I'm talking about things like options, swaps, futures, forwards, things like that. I know there's a lot of people who are going to disagree with me on this. It's going to piss off a lot of people. I think for the most part, derivatives are too complicated for the vast majority of the population. So that right there, I think wipes out about like 95% of the population in the sense that they don't have the background. They're not going to invest the time to understand it. So I think, if you're not going to do that, it just doesn't make any sense to you. I also think, they're really bad from a tax standpoint. You are still speculating. I don't care what anybody says. With derivatives, you are still speculating. They are not things that you can invest and own long term. So that right there takes them off my plate. And, just the last few reasons I'll say is that, hedge funds trade a lot in derivatives. And, this is a big strategy of a lot of the really biggest hedge funds out there, most prestigious hedge funds. If they can't figure it out and do it in a way that they're beating the market on a long-term basis, then I certainly am not going to be able to. So if they, and that's the proof, right? Hedge funds do not on a long-term basis beat the market. So why am I going to think that I can do these strategies better than they do? I don't know. I just understand that that's not going to be the reality. Also, the people that, recommend these and don't recommend these, I think is very interesting to me. So, Buffett has used things like credit default swaps, interest rate swaps, but what he's doing is very different than what people are doing when they talk about, trading derivatives and stuff like that. I think really the only people, and that's why I have this guy here, is these finance YouTubers who talk about, doing, options and swaps and things like that. And they always have this haircut. They always have, that's why I put that. I feel like they always have the same haircut. So, I'm just not going to do it, right? Buffett calls these, I think he calls them financial weapons of mass destruction. I think you can get in a lot of trouble, and they're just not for me. So I know that there's a lot of people who disagree with me, but that's my opinion on that. So these are just 7 assets that, I would never consider investing in, things I would never own myself. This is the end of the asset allocation series. Hopefully you found this series helpful, and hopefully you have a better understanding, at least my thoughts on how you should think about allocating your money across the different asset classes.